Everyone tells you to max your 401k. They are not wrong. They are just incomplete. Because the same advice column that tells you to contribute up to the match, the same employer benefits brochure that calls your 401 tax advantaged, the same calculator that projects a comfortable retirement based on a 7% annual return, none of them tell you about the termites. I want to walk you through something that almost nobody who has a 401 kick actually understands. There are fees inside your retirement account, not the kind printed on a statement, not the kind your HR rep mentioned at orientation. These are the fees that get extracted before your statement is even printed. They are layered, they are technical, they are completely legal, and over a working career, they will quietly remove $300,000 or more from your retirement. Not because anyone broke the law, not because anyone stole from you, because you never asked, and because the system was specifically designed so that you would not have to. Let me show you how the math works. Then let me tell you about David. There are at least 4 layers of fees inside a typical 401k plan. Most people are aware of 1. Some sophisticated savers know about 2. Almost no one tracks all 4. The first layer is the expense ratio of the mutual funds inside your plan. This is the fee the fund company charges to manage the money. In an actively managed large cap fund, this can run between 0.5% and 1.25% a year. In an index fund, it might run between 5 and 20 basis points a year. This is the only fee most savers ever see, and even then, only if they go looking for it. The second layer is administrative fees. Someone has to run the 401k plan. Someone has to handle the paperwork, the website, the customer service line, the compliance filings. That work is done by a record keeper, and the record keeper gets paid. Sometimes the employer covers this cost. More often, the cost is quietly deducted from your account balance as a flat dollar amount, a percentage of assets, or both. You will not see it as a separate line. It is netted out of your fund returns before you ever see them. The third layer is the one nobody talks about, and it is the one that costs the most. It is called revenue sharing. The mutual funds inside your plan often pay a portion of their expense ratio back to the record keeper as a kind of finder's fee for being included in the plan menu. The funds that pay revenue sharing tend to have higher expense ratios. The funds that do not pay revenue sharing tend to have lower expense ratios. Guess which kind of fund tends to end up on the menu? The fourth layer is the wrapper fee. Many plans now default new employees into a target date fund. The target date fund is itself a fund of funds, which means it charges its own management fee on top of the expense ratios of the underlying funds. So you are paying a fee on a fee. The Department of Labor has flagged this practice for over a decade. Most workers in target date funds have no idea. This is where the math gets uncomfortable. Imagine a saver who puts away $10,000 a year for 30 years. The market returns 7% annually. In a plan with rock-bottom fees, 10 basis points all in, this person ends with just over $1 million. Same saver, same contributions, same 30 years, same market return. But the fees inside the plan total 1% a year instead of 10 basis points. This person ends with around $820,000. The difference is nearly $200,000. The saver did not behave any differently. They did not pick a worse fund manager. They did not buy and sell at the wrong time. They did exactly what every retirement guide told them to do, and they ended up with 20% less money because the fees inside their plan happened to be average instead of excellent. Pliv the fee load up to 1.5%, which is not unusual in a small employer plan, and the gap grows to more than $300,000 over the same career. Push it to 2%, and you have lost more than $400,000 to fees you never saw a bill for. This is what I mean when I say the termites. The damage is not dramatic. It is not visible on any monthly statement. It compounds quietly, year after year, eating a percentage that sounds tiny when you say it aloud and amounts to a house when you finish. Let me tell you about David. David is a friend of a friend, 56 years old, software engineer at a mid-sized tech firm in Austin. He has been maxing his 401k for 19 years. By the time we sat down to look at his plan together last spring, he had a balance of just under $900,000. He felt good about it. He had done the work. He had contributed every paycheck. He had not panicked in 2020. He had not chased anything in 2021. I asked him what his expense ratios were. He did not know. I asked him what his administrative fees were. He thought his employer paid them. I asked him if he had ever read his 408(b)(2) disclosure, which is the federally required document that lays out every fee in his plan in plain English. He had never heard of it. We pulled the disclosure together. His target date fund had a stated expense ratio of 57 basis points, which is not great, but not unusual. The underlying funds inside the target date wrapper, however, were carrying expense ratios that brought the total fee load to 94 basis points. On top of that, there was a flat $30 quarterly record-keeping fee deducted from his balance. On top of that, there was a fund-level revenue-sharing arrangement that, when fully unpacked, added another 12 basis points to his all-in cost. Total damage, roughly 1.25% a year on a portfolio approaching $1 million. $11,000 in fees last year alone. He had been told repeatedly that his plan was low cost. We ran the math backward. If David had been in a plan with a 15 basis point fee load, which is what a well-run plan at a Fortune 500 employer typically offers, his balance would be somewhere around $1,200,000 today instead of $900,000. $300,000. That is the cost of the termites in his particular house. Not because anyone broke the law, because nobody told him to ask. Here is the worldview shift. And I want you to sit with it for a moment because it is going to feel uncomfortable. The 401(k) system was not designed against you. It was designed for the people who built it. The fund companies that earn the expense ratios. The record keepers that earn the administrative fees. The platforms that collect the revenue sharing. The intermediaries that built target date wrappers as a product category. Every layer of that system has a business reason to exist, and every layer of that system has a financial incentive to be on the menu when you enroll. Your employer is not necessarily in on this. In many cases, the HR team that selected the plan does not understand the fee architecture either. They were sold a plan by a broker who was incentivized by the fund company, which had a revenue sharing arrangement with the record keeper. The whole chain operates on the assumption that the end participant, namely you, will never read the disclosure. The Department of Labor's own data suggests that fewer than 1 in 10 plan participants has ever opened the document. Industry benchmarks from Brightscope consistently show small employer plans running well above 1% all in, while large employer plans have been driven below 20 basis points by competitive pressure. Same market, same funds in many cases. Wildly different costs decided entirely by who negotiated the plan. That is the design. That is the trick. Not a scam, not a crime. A system that costs nothing to the people who build it and a fortune to the people who do not look. So what do you actually do? First, request your 408(b)(2) disclosure. Email your HR department. They are legally required to provide it, and most workers have never asked. Read the section labeled Fund Level Expenses and the section labeled Plan Level Expenses. Add the numbers up. That is your all-in cost. If it is above 50 basis points and your plan offers index fund alternatives, switch to the index funds. Second, look at the target date fund. If your plan has both a target date fund and a low-cost index fund alternative, building your own simple allocation, a total market index, a bond index, an international index, will almost always cost less than the wrapper. The wrapper exists for convenience. You are paying for the convenience. Third, if your plan is expensive across every option, contribute only up to the employer match. The match is free money you cannot replicate. Anything above the match, contribute to an individual retirement account instead, where you can pick a low-cost fund yourself. You give up some tax deferral flexibility, but you save more in fees than you lose in tax efficiency for most income levels. Fourth, if you are a senior employee with influence, push your HR team to bid the plan out. Record keepers compete on price now. A plan that was put in place 10 years ago is almost certainly more expensive than what is available today. Most employers do not renegotiate because nobody pushes them to. Here is what I want you to leave with. The number you saw on your last statement is not the number you earned. It is the number you earned minus the number you did not see being taken. Over a 30 or 40-year career, The gap between those two numbers is the difference between retiring comfortably and retiring later than you planned. This is not a scandal. It is not breaking news. It is a slow, structural, completely legal redistribution from the people who contribute to the people who manage the contributions. It has been happening for 30 years. The Department of Labor has been trying to surface it with disclosure rules for 15 years. The disclosures get printed. The disclosures do not get read. The fix is not complicated. The fix is asking for the document, doing the addition, and making one switch. That is it. The whole termite problem can be solved in most plans with one afternoon and one email. So write the email, get the disclosure, run the numbers. And the next time someone tells you your plan is low cost, ask them politely and specifically what the all-in fee load actually is, including revenue sharing, including administrative fees, including wrapper costs. Because if the difference between a comfortable retirement and a delayed one is 1% a year for 30 years, that 1% is not a rounding error. That 1% is a house. I am Ben. Check the disclosure.